Hello students, and a very warm welcome to another new set of lesson videos from the chapter Theory Base of Accounting. Well, that's quite an interesting name, Theory Base. And yes, to know the subject properly, all of you must have a very strong understanding of the theory part before we delve into the practical problems. At the onset, let's get introduced to Sam and his dear grandpa. Grandpa has been a veteran accountant and consultant for many years now. He has his accounting and consultancy firm, which is quite a success. However, Sam, like all of us, wants to learn it fast and quickly, and dear grandpa keeps on innovating interesting ways to teach him. As we have already learned that accountancy is all about recording, classifying, and summarizing the financial transactions and events and interpreting the results thereof. However, there are two distinct categories of the users of accounting information: external users and internal users. The main two characteristics of a meaningful accounting information: one is reliable and the other is comparable. Now, let me ask you a very quick question. What do you think is the most important gamut of the accounting information? Well, it is the financial statements, which are prepared and published over the years. Now, how do we ensure absolute fair comparison of interperiodic books of accounts? Yes, it's the comparability of the statements. And what do we do to make the financial statements comparable? Remember your mom participating in the baking competition the other day? And remember the ground rules? They were all given the exact same set of ingredients to make the chocolate cheesecake. And why so? Because the cakes had to compete each other and had to be comparable. Likewise, the financial statements too, to remain comparable, should be based on consistent accounting policies, principles, and practices. Consistency is the bottom line for all the chain of events, starting from capturing the transactions till the publishing of the financial statements. And all such work calls in for a established theory base. And just like any other discipline, a rock-solid theory base helps to strengthen the process of accountancy and its enhanced usage to the users. This is a sunny Sunday, and Grandpa tries to imbibe the spirit of accountancy. We will start with Generally Accepted Accounting Principles, that is GAAP. These are the general rules which have been accepted by the accounting professionals over a period of time. However, these principles are not static in nature. Over a period of time, with changes in legal, social and economic environment, and also with the changing needs of end users, these principles constantly get a newer shade. However, throughout this video, we will be using the word principles interchangeably with the concepts and conventions. The necessary assumptions and ideas, which are basics to the accounting practice, are called concepts, whereas convention means customs or tradition which act as a guide to the preparation of accounting statements. Also, take a note that the terms like principle, postulates, modifying principles, conventions, assumptions have all been used interchangeably throughout the lesson. There are 13 broad important concepts, which are the basic accounting concepts, which primarily classifies the working rules for all accounting activities. It's a cool Sunday afternoon. Sam and Grandpa are both at home today, and right there in the terrace, Grandpa is all set for the classes. 1. The business entity concept. Distinct and separate entity from the ones who own the business. The accounting records are maintained from the point of view of the business and not from that of the owner. Suppose the private limited company Grandpa formulated 50 years back has a separate entity of its own. Grandpa has been putting in capital so many times there. However, for Synergy Private Limited, the capital amount received from Grandpa is distinctly a liability, as it is an inflow of funds from a third party. So the business entity concept is very easy to remember. Just as any other individual, the business house needs a separate and unique treatment with respect to everyone. 2. Money measurement concept. only those transactions or happenings which can be converted into cash are to be captured in the books of accounts. The transactions are captured in their monetary units and not in physical units. For example, 5 units of chair at the rate of 10,000 per chair should be captured as rupees 50,000 and not as 5 chairs or units. Sam is listening to this very attentively, and Grandpa wants to check his understanding. I love all my employees so very much. How do you think we will capture this in the books of accounts? And Sam burst out in laughter. And yes, Grandpa is confirmed that Sam has understood this properly. And just like Sam, all of you should understand this properly. Be it the capability of the human resources, the appointment of a manager, or the harmony or cooperation within fellow workers, these are never captured because the concept of money measurement follows the recording of only those transactions which can be converted into monetary unit. 3. Going concern concept. The concern or the entity continues till perpetuity. This assumption of perpetuity is the very basis of valuation of the assets in the balance sheet. There are so many high-value assets like computers, 3D printers in Grandpa's office. The 3D printer purchased last year worth rupees 60,000 is approximated to last for 6 years. Since Synergy Private Limited will be using this printer for 6 years now, it is not logical to assign the entire cost of the asset to the profit of the purchasing year only. Instead, to be precise and logical, only the cost of the asset consumed or used during the period should be set off against the profit of that period. So, this assumption of continuity helps us to assign only that part of the asset which has been consumed to earn the profit of that particular year. The remaining asset value needs to be set off in the future years for future years' profit, and exactly here the going concern concept comes in. 4. Accounting period concept. This refers to the standard time frame for which the financial statements of an entity is prepared. Financial statements are made available to end users at regular intervals, usually 1 year, and this time interval is known as the accounting period. Synergy Private Limited follows the Income Tax Act and the Companies Act 2013, which mandates that the income statements should be prepared annually. However, also for your note, companies whose shares are listed on the stock exchange, meaning to say that listed companies are required to prepare and publish their results quarterly. Well, on that note, Grandpa and Sam just looked around and thought to close off. It was getting dark and both of them wanted a break. Well, on that note, students, we too will close our lesson for now. See you soon in the next part of the lesson. Till then, happy learning.